This LOS is identify characteristics of companies for which the constant growth or a multistage dividend discount model is appropriate. Multistage dividend discount models. The dividend discount model can be extended to as many stages as deemed appropriate. For most publicly traded companies, that is, companies beyond the startup stage, practitioners assume growth will ultimately fall into 3 stages: 1, growth; 2, transition; and 3, maturity. The assumption supports the use of a 3-stage dividend discount model, which makes use of 3 growth rates: a high growth rate for the initial finite period, followed by a lower growth rate for a finite second period, followed by a lower sustainable growth rate into perpetuity. One can make the case that a 3-stage dividend discount model would be most appropriate for a fairly young company, one that is just entering the growth phase. The 2-stage dividend discount model would be appropriate to estimate the value of an older company that has already moved through its growth phase and is currently in the transition phase, a period with a higher growth rate than the sustainable growth rate prior to moving to the maturity phase. That's the period with a lower sustainable growth rate. However, the choice of a 2-stage dividend discount model need not rely solely on the age of the company. Long-established companies sometimes manage to restart above average growth through, for example, innovation, expansion to new markets, or acquisitions. Or a company's long-run growth rate may be interrupted by a period of subnormal performance. If growth is expected to be moderate in the first case, or improve in the second case towards some long-term growth rate, a 2-stage dividend discount model may be appropriate. So a quick practice question to check our understanding. The best model to use when valuing a young dividend-paying company that is just entering the growth phase is most likely A, Gordon growth model; B, 2-stage dividend discount model; or C, 3-stage dividend discount model. C is correct. So a young dividend-paying company is just entering the growth phase. It's not transition or sustainable. So C is correct. It's the 3-stage dividend discount model. The Gordon growth model is best suited for valuing mature companies. The 2-stage model is best for companies that are transitioning from a growth stage to a mature stage. And the 3-stage model is appropriate for young companies just entering the growth phase. So we'll do another practice question where we have to do some calculations. An analyst gathers the following data about a company with a double-digit growth rate that is expected to continue for 2 years. So the current year dividend per share is €2. The growth rate in dividends during the next 3 years is 30% in each of the years 1 and 2 and 20% in year 3. The growth rate in dividend for year 4 and beyond is 8%. The weighted average cost of capital is 12%, and the cost of equity capital is 15%. The best estimate of the company's value per share is closest to A, €48.68, B, €50.68, or C, €85.93. Okay, this question is not too difficult, even though it's going through various stages of growth. The correct answer is A, but let's see how we get the calculation. We need to do the present value of the dividends plus the present value of the terminal value, okay? And we don't need the weighted average cost of capital. That's put in as red herring information. We're using the cost of equity capital. That's our R, okay? So for the current dividend is €2. So to get the first dividend is going to be €2 times 1.3 equals 260. And then we're going to do the present value. We're discounting back by 15%. To get the second dividend, and I can bring up the calculator very quickly, just clear it off. So 2 times 1.3, and I can multiply by 1.3 again, and I'm going to have 3.38 for my second dividend. And then again, I'm just discounting it back using 15% for 2 years. And then finally, the third dividend, I'm going to take that last dividend, just bring up my calculator again, the 3.38, but it's going to be 20%, so it's just times 1.2. So you can see these questions are getting easier, and my dividend is going to be 4.056, okay? 4.056, we can see there was rounding here in the solution to 4.06, discounted back. Now this is the key thing here. So that's our dividend in year 3, and that's when, okay, so now we're going to do the value 3 equals our dividend in year 4 divided by R minus G. So let's just have a look there. I'll just clean that up a bit. So the value 3 equals D4 over R minus G. Now we have the D3, but after that, it's going to grow at 8%. So you can see for the numerator, the dividend is $4.06 times 1.8 divided by our R minus G. Again, we're using the 15% and the 8%. So I'm not going to bring up the calculator to do it in the interest of time. We've done these calculations before in previous LOS. You can work your way through it. We're getting the terminal value of 41.19. Add them all together and you get 48.68. So this is a type of question I like to see on the test because it's very mechanical. Yes, there are some calculations that you need to do. Speed is a skill. Skill gets rewarded. Pay attention to your keystrokes. But in general, you're just calculating step 1, calculate your dividends. Step 2, calculate the present value of those dividends. Step 3, calculate the terminal value. Step 4, calculate the present value of the terminal value. Step 5, add them all up together. Okay? We'll review another quick practice question. An analyst gathers the following data about a company and the market. Earnings per share, most recent year, $2. Expected growth rate of dividends, 5.10%. Dividend payout ratio, 60%. Stocks beta, 1.5. Market risk premium, 5.6%. Risk-free rate, 4.2%. And the company's weighted average cost of capital, 12%. So using the dividend discount model, the company's price per share in dollars is closest to A, $16, B, $16.82, or C, $18.28. Okay, let's work our way through this. So you can see, first of all, we had to calculate the dividend per share. So they're giving us the earnings per share and they're giving us the payout ratio. Okay, so that shouldn't be too hard. It's going to be $2 times 0.6, and that's going to give us $1.20. Okay, just be careful. It's the payout ratio and not the retention rate. Okay, the retention rate therefore would be 40%. And G equals retention rate times ROE. So we've seen this a couple of times. Now the next thing is they're giving us the weighted average cost of capital. We don't need it. That's red herring. We need R. We need the required return for the equity. Okay, and you can see we're going to use CAPM for that, where they're giving us the stock beta, the market risk premium. Be careful. That's not the market return. It's the risk premium. This is what I said to keep your eyes open for. Be very careful with the wording, and the risk-free rate. So the CAPM should be easy. The required return is the risk-free rate plus the beta times the return to the market minus the risk-free rate, okay? And you can see this return to the market minus the risk-free rate, that's the market risk premium, that's the 5.6%, okay? Don't subtract 4.2% from 5.6% as the market return, you'll get an error. So you can see that's really easy. The required return is the risk-free rate, 4.2%. Plus the 5.6, the market risk premium times the beta, we get 12.6%. Okay, so R equals 12.6%. And then finally, G, wait a minute, they've given us the expected growth rate of dividends. Anyhow, G equals retention rate times ROE. You can see all the different subcalculations that we could sometimes make, but in this case, they're giving us the G at 5.10%. So now we can do our calculation. D1, we're going to have to grow our dividend. D1 is going to be a $1.20 times 1.051 for our numerator, and that's going to be divided by K minus G, R minus G, which is 0.126 minus our 0.051 on the growth rate, okay? And so you can see here the value of the numerator, $1.20, because we have D naught. Don't forget that's D naught, the $1.20, we need D1, okay? So it's $1.20 times 1.051, the growth rate, okay? And divided by R minus G. R we calculated using the CAPM, and G has been given to us. And anyhow, when you work through the math, it's going to give us 16.82. The correct answer is B. So I think you'll agree by now that these questions, you know, if you first looked at this without having done much practice, they seem a little bit intimidating, but the more that you do it, they become easier and easier, okay? Nice little question, this one. Very good practice on a number of different concepts that you need to know. Okay, one of the tips that I say is sometimes when I see a table like this, I'm going to read down at the question first. And so when I look at the table, I know what I'm looking for. So it says using a two-stage dividend discount model, the value per share of this common stock in 2012 is A, $28.57, B, $31.57, or C, $38.70. So now when I go back up and look at the table, it says an investor evaluating a company's common stock for investment has gathered the following information. Earnings per share in 2012, $2.50. Dividend payout in 2012, 60%. Dividend growth rate expected in 2013-14, 25%. After that, 2014, 5%, sustainable growth rate, and an investor's required rate of return, 12%. So this question is just a straight out using the two-stage dividend discount model. Okay, we'll work through this question fairly slowly. Again, it's just very mechanical. So step one, what we need to do is we need to calculate the dividend. That's always the first step. And we can see that we had the earnings per share at $2.50, and the payout ratio is 60%. So that should be easy to calculate. The dividend is 250 times 0.6. We're going to have $1.50, okay? And that was our current dividend. Now we know it's going to grow for 2 years at 25%. So we need to calculate our D1 and we need to calculate our D2. And that's fairly easy. We take the $1.50 times 1.25. We've got our D1. And then for our D2, it's $1.50 times 1.25 times 1.25, or 1.25 squared, okay? So that's step one, we calculate the dividend. Step two, we do the present value of the dividend. In this case, they're giving us the investor's required rate of return, so we're discounting back by 12%. So D1 divided by 1.12, D2 divided by 1.12 squared, okay? So those are the two dividends. And then what we need to do is we need to calculate the terminal value. So what we're going to do is we're going to calculate the P2 equals the D3 over R minus G. Okay, so for D3, we can see here's the calculation. It's the $1.50 times 1.25 times 1.25 for the 2 years, and then times 1.05. R is given to us as 0.12. G is given to us as 0.05. Here's our growth rate after 2014, so that's you need to use that. And then you can see how they've done the terminal value here. V2 equals D3 over R minus G times 1 divided by 1.12 to the 2. Because don't forget, that's P2. You're discounting it back for just the 2 years. So what do you get? I'm not going to bring up the calculator in the interest of time to work through all the math. It's just mechanical. $1.67 is the present value of dividend 1. $1.87 is the present value of dividend number 2, and $28.03 is the present value of the terminal value. Add them all up together, you get 31.57. So the correct answer is B. Okay, again, just a very mechanical question asking you to crank through a number of present value calculations. Number one, calculate the dividend. Number two, calculate the future dividends. First one is the dividend using the payout ratio. Calculate the future dividends. Do the present value of the dividends. Calculate the terminal value. Calculate the present value of the terminal value, and then sum them all up. Okay. Just in case you needed more practice, one last practice question that has the math. Okay. Maybe it's overkill, but who knows? Better, the more practice, the better, right? So we have next year's sales revenue, $180 million. Next year's profit margin, 15%. Dividend payout ratio, 60%. They seem to like that number. Dividend growth rate during years 2 and 3, 25%. Dividend growth rate after year 3, 5%. Investors' required rate of return, 12%. And the number of outstanding shares, 8.1 million. So the current value of the share of the company's common stock, according to the two-stage model, is closest to A, $39.36, B, $49.20, or C, $51.20. Okay, the reason why I wanted to add one last question with some calculations is they're just giving us another wrinkle here. But it's not difficult. They're giving us the sales revenue, they're giving us the profit margin, they're giving us the payout ratio, and they're giving us the number of shares. So what we needed to do is we needed to calculate the dividend per share, okay? So it's not that difficult. We have to do 180 million times the profit margin, which is 15%, and then we're going to, the payout ratio is times 0.6, and then we're going to divide by the 8.1 million shares, okay? So if you do that, 180 times 0.15 times 0.6 divided by 8.1, we're going to get $2 per share. Now it just becomes the type of question that we're familiar with. That's the dividend, $2. And by the way, this says next year's sales revenue, next year's profit margin. So that is the D1, okay? So when we get that $2, that is the D1. Then it says during 2 and 3, we're going to grow it by 25%. So you can see D2, $2 times 1.25, 250. $2 times 1.25 to the power of 2, 313. And then you can see after that, it's going to go to 5%. So it's going to be $2 times 1.05 times 1.25 times 1.25 times 1.05 gives us $3.28. Okay, so that's our D4. And V3 is going to be D4 over K minus G. Don't forget we're using the new growth rate always, and they're giving us the investor's required rate of return. So I'm not going to bring up the calculator and crank through all this just in the interest of time, but you can see I think it's becoming fairly easy that here's my D1, which we calculated, because again, this said next year's sales. There's my D2, there's my D3, and there's my terminal value, which was V3 equals D4 over R minus G, okay? And that's why we're discounting back by 3 years, okay? And it's giving us the correct answer of A, if you do the math, $39.36. So again, a lot of practice on these. The more you do, the quicker you get, no problems. And one last practice question to finish this LOS, but with no math, a bit of theory. Which of the following is most likely considered a weakness of the present value models? A, present value models cannot be used for companies that do not pay dividends. B, small changes in model assumptions and inputs can result in large changes in computed intrinsic value of the security. Or C, the value of the security depends on the investor's holding period. Thus, comparing valuations of different companies for different investors is difficult. Okay, B is correct. Very small changes in inputs, such as the required rate of return or the dividend growth rate, can result in large changes to valuation model output. Some present value models, such as free cash flow to equity models, can be used to value companies without dividends. Also, the intrinsic value of security is independent of the investor's holding period. So a nice little question to end on. And on that note, that's the last slide for this LOS. Thank you.